What is going on, value investors, friends, family, people of YouTube? Today, I spent the entire day reading this article entitled, What Affects the Price Movements in Bitcoin and Ethereum? And this is something I think you guys are going to find interesting because they come to a very elegant conclusion about what exactly is driving price movements in Bitcoin, Ethereum, and that has important implication, of course, generalized to other cryptocurrencies. So let me pull this right up for you guys. I have the link to this article in the description box below this video if you are watching it after the live stream. If you're new here, I want to say welcome to my channel and subscribe so you can continue to gain insight on how to analyze business performance so that your investment performance is optimized. Remember, when your investment performance is optimized, so is your wealth production. I want to start off by reading the abstract of this article here. And now this is by Sabelonius and Friends, and it's coming out of, it looks like Korea, published in the Manchester School Journal. And they say this study aims to explain price movements in the two largest cryptocurrencies that represent the majority of cryptocurrency market capitalization, Bitcoin and Ethereum. A var-Garch-Beck model is estimated to analyze how Google search interest, number of tweets, and active addresses on the blockchain impact prices of Bitcoin and Ethereum over time. We find solid evidence that the amount of active addresses is the most significant variable among others influencing price movements in Bitcoin and Ethereum. Based on spillover effects and GERFs, Google searches and tweets to a certain extent have impacts on Bitcoin and Ethereum prices, but the impacts are weaker than that of active addresses in terms of magnitude and significance. Now, this is an incredible finding, and I want to actually go through. It's not going to match up one-to-one with what's shown on the screen versus what I have here. I read through this entire document, and I've made highlights that I believe will add value to your life if you're a value investor yourself, and you're looking for some everlasting principles, right? Some rational principles that you could use to help drive your investments in the cryptocurrency space. It's a nascent asset class, and there aren't really too many rules to play by. You know, I mean, we have this book here for stocks and equities, right? But we don't really have a book yet written for cryptocurrency rational investing. So this article kind of sheds a bit of light into the matter. On page, let's see, on these, so it says page 103. The authors go on to say that both Bitcoin and Ethereum represent money of the new digital age and are the language of data and information. It is money for the internet that cannot be confiscated, inflated, or banned by anyone, right? So they're talking about the value of blockchain technology in general. There are thousands of cryptocurrencies that are very different and are used to solve problems in various industries, including banking, insurance, supply chain, information, communication technology, and medical devices. Now, here's the highlight piece. Cryptocurrencies also aim to connect almost 3 billion people from developing countries to the global financial system. And a quick Google search will tell you, unfortunately, that approximately 25% of our world's population goes unbanked. Now, you might be wondering why that's a problem. Well, it complicates life dramatically if individuals don't have access to financial services like insurance, debit credit systems, etc. So I won't go into too much detail. There's a lot of literature written on the subject, and if you're curious, I suggest you go on Google and check it out. But cryptocurrency is aiming to really help out in that matter, really ameliorate the world circumstance when it comes to finances and transacting value. So they go on to say in 2017 and 2018, the cryptocurrency market exploded. Market capitalization increased by approximately 4,000%, and if you were invested in the market, I'm sure you remember that. And its peak amounted to over $800 billion in United States currency. Millions of people got involved in this new phenomenon, and something I have highlighted here, as cryptocurrency market capitalization increased and more people and businesses became involved in trading Bitcoin, Ethereum, etc., the problem of how to accurately value cryptocurrencies and forecast their prices emerged naturally. Using traditional financial models did not work, and here's the highlighted piece, because cryptocurrency fundamentals are different from company stocks, fiat currencies, or other normal financial assets like metals. And if you were watching yesterday's live stream, I talked about this, and I talked about how some researchers actually took a look at the different commodities, the different financial securities and financial instruments that are available traditionally to the public and to private institutions. And they took a look at what prices, specifically, let's say gold, right? Do gold prices and the overall econometrics of gold, do they co-move with Bitcoin, for example, in the overall cryptocurrency market? No, they don't. Do they co-move with, I don't know, something like properties, REICs? No. Do they co-move with fiat currency? They don't. They don't. The only, the only relationship that was somewhat significant, and I mean that in the formal scientific sense, was the relationship between cryptocurrencies and high profit firms. And this is me kind of venturing into speculative space here, but they didn't exactly specify what firms correlated best with Bitcoin and cryptocurrency, but I believe that it was platform companies who naturally have high profits. These publicly traded companies like Amazon, Apple, etc., Tencent, Alibaba, these platform companies that are because of the economics involved in being a platform company, they naturally have higher profits than perhaps a vertically integrated direct-to-consumer company. Now, the scientific article didn't say that, and in the interest of scientific merit, I do have to disclaim that that's just me speculating, but I would be curious to see if someone would shed some formal light on that. Anyways, moving forward, on the same page, some academics proposed valuing cryptocurrencies as a network rather than as a financial asset, an approach used to value information communication networks and social networks such as Facebook, which is exactly what we were just talking about. And I really think that cryptocurrency is serving a similar role as Facebook and as some of these other platform companies, except that it's not a centralized service and there aren't centralized profits and there isn't one person leading it, like in our 1900s traditional business model. It's a distributed computer, right? It's a global computer that serves to transact value using the internet, right? Michio Kaku talks about how the internet is one of our, if not the very first Type 1 civilization communication system. Well, we might be looking at the birth of a medium that transacts value for us, and it could be potentially considered a Type 1 civilization. If you don't know what a Type 1 civilization is, I would Google it, but they go from 0, 1, 2, 3, 4, and beyond, and it relates to energy consumption and is a way to classify different civilizations on the basis of their energy consumption. But there are other specifications to that. Anywho, pushing forward, the aim of this study is to understand what drives price movements in Bitcoin and Ethereum. A combined theoretical approach based on Metcalfe's law and investor online activity has been suggested to calculate future price movements. Now, Metcalfe's law reflects the real long-term fundamental value of Bitcoin and Ethereum, while investor online activity reflects short to medium-term investor sentiment and deviations from equilibrium price. Excuse me. According to Metcalfe's law, the value of a network equals the square number of its users. So there's some proponents to this model, right? This isn't the only research article that exists that talks about basically predicting the price of any one cryptocurrency using Metcalfe's law. There are other research articles that do that, but there are some opponents, right? There's some proponents to it, but then there are some opponents. Namely this gentleman that I want to show you guys. His name is Andrew Odlyzko, and he has been quoted as specifically saying that he does not like Metcalfe's law, but even on the Wikipedia page, right, so it says right here, so for example, by Metcalfe, if a hypothetical network of 100,000 members has a value of $1 million, doubling its membership would increase its value 4 times. So this is what the research is saying that Bitcoin, for example, benefits from, because Bitcoin only gets its value from how many users are on the network transacting value. I mean, this makes common sense. However, they go on to say that Odlyzko predicts that its value would only be slightly more than double using this very simple log function here. So it's just n times log of n at a base of 10. However, on his very own Wikipedia page, it goes on to say that empirical tests, in part stimulated by this criticism, strongly support Metcalfe's law. And guys, I actually did my own test, which I want to show you. I wanted to see, who's right. So what I did was I downloaded data that's readily available and accessible to the public from Ethereum's own blockchain, and I took it to as far back as the 2015s, and all I did was I downloaded the active addresses, the active user addresses in column C here. So unique address total count, and this is all according to the research, right? And then I simply applied Metcalfe's law, and Metcalfe's law, the simple version, is just n, or number of users, squared. And from the research, they say that if you do this, then you can, to a certain degree of accuracy, describe the market capitalization at any one period of time for the specific cryptocurrency in question, right? And then I also did Odlyzko's, or the prior gentleman that we discussed, who doesn't really like Metcalfe's law. I did his version too, where it's just the number of users times the log of the number of users, and you can see my referencing here. And I took a look at the correlation between our output produced and the actual documented market capitalization at any one period of time going back to 2015. And it turns out, in fact, that the Metcalfe's law method is more accurate by 10 percentage points as compared to the log method proposed by this gentleman. Now, one thing that I like about the gentleman's Odlyzko's method is that it's very conservative. And even on this YouTube channel, I've been accused of being far too conservative with my valuations. And I understand that people want something that matches reality, but sometimes reality is stranger than fiction. And we see that with GME and AMC, where the fundamentals of the company don't make any sense to warrant the price that the stock is trading at. But that's a beef that I have with almost the entire internet, so we won't go there. What I will say is that this correlation doesn't lie, right? So the log method doesn't really match too well as far as the correlation goes as compared to this method. And, after thinking about it really deeply, guys, I honestly think that the log method, while I understand the merit behind him saying that if you already have, let's say, 2 billion people who are actively trading on the Bitcoin network, right? Then let's say I'm antiquated and I'm not on the Bitcoin network, but then I suddenly join. So then you're gonna this is me speaking in his voice. So then you're gonna tell me that this guy is worth n plus 1 squared, and we're gonna have an extreme amount of value because this one extra person joined. After already having 3 billion people, you know what I mean? He's basically saying that it doesn't matter if after a certain amount, after a critical mass, the next guy doesn't even have to join. Who cares about the next guy? But, I would go on to say that I think that, while I understand the logic, I think that he's really undervaluing what's going on here. And I think that cryptocurrency being a new asset class, I see this as a huge. There's a really big demand for us to get rid of banks, to get rid of the middleman. If I'm speaking honestly here, guys, let me cut the PC crap for a second. Who likes the middleman? They do nothing, and they lie and steal and cheat. And this isn't some conspiracy theory stuff. You look at what happened in 2008 in the global financial crisis. That was some really loose practice, and they were playing around with the world's money, and they caused a complete meltdown and a lot of insecurity and a lot of pain and suffering that could have been avoided had we had a system in place, a trustless system in place to take care of our transacting for us. And this is exactly what cryptocurrency brings us. And again, I'll take a look at the emerging economies of our world. You look at El Salvador, you look at Argentina, you look at Venezuela, we look at some countries in Northern Africa, the Middle East, and South Asia. And we're all looking for an intermediary that is trustless, that we can simply use to exchange value, without unnecessary disclosure of privacy. I guess the inner libertarian is coming out in me here. But anyways, I think that nothing against the guy personally, this log guy here, but I think that this log method is fundamentally undervaluing what cryptocurrency really brings in terms of value to our world. And in fact, I would even argue that the model isn't really enough. And in fact, there might be even more value to be had, and this method here might be undervaluing it a little bit. So anyways, let's push forward with our article here. So some more highlighted pieces. The aim of the study is to understand what drives price movements. According to Metcalfe's law, the value of a network equals the square number of its users. And let's push down here. Excuse me. Right down here, this last paragraph. Empirical results are valuable to understand the relationships between the number of Bitcoin and Ethereum users and price changes over time. Understand relationships between public interest in cryptocurrencies and price changes over time. And number 3, understand relationships between cryptocurrency and news dissemination online and price changes over time. So, on this second page here for the literature review, the article says, using the VECM model, researchers show that more positive posts online resulted in rising Bitcoin prices. The minority of social media platform users accounted for approximately 60% of total online posts, the so-called vocal minority, while the majority of users, 95%, accounted for approximately 40% of total online posts. This is called the silent majority. However, investor sentiment from silent majority posts was found to have a more significant impact on Bitcoin prices. Researchers also noted that social media platforms impact Bitcoin's price differently. Posts on online forums had a stronger impact on Bitcoin's prices as compared to posts on Twitter. So I guess shout out to all the Reddit bros out there who are trying to move numbers in the cryptocurrency space. Yeah, I guess it's working. A little bit further down, when Bitcoin prices rapidly increased, bubble-like intervals, correlation with online social media activity strengthened. Positive correlation over the medium term during bubble intervals. These findings confirmed that Bitcoin is a highly speculative asset and that during bubble cycles, Bitcoin's price movement is based on rumors and emotions spreading on social media more than rational calculations. During short time periods, relationships between social media activity and Bitcoin prices are weak due to shocks caused by daily news and short-term trading positions. And this is why, guys, if you are a rational investor and you care about your money and you understand that time is the most powerful asset that we have, right? Then this is why we want to avoid the hubbub. Most recently I joined, I've been more active on Reddit in terms of the reading that I do and trying to keep up with the news, and it's really emotionally draining. And I'm not introverted, guys. I'm a really extroverted guy, but going through all those articles and all these opinions and comments, it's no wonder why I have an inclination, and probably you feel the same, an inclination towards value investing, because you kind of just want to kick back. You want to kick back and you want to just have confidence in your method and know that your method it may take some time, but you're willing to wait because you're a patient individual and you're not trying to get into a get-rich-quick scheme or day trade, which has been shown empirically to not be profitable and, in fact, end up having more folks lose money day trading than not. But that's the sentiment I get from these Reddit bros and the online commentary, even on YouTube. You look at someone, I forget the guy's name, someone like Coin something, and you look at the at the images and the styling of the what are they called, of the thumbnails on his YouTube videos, and the saturation is very high. The colors that are used are striking and attention grabbing. The use of a lot of yellow, a lot of neons, a lot of highlights, kind of inflationary language used as well, kind of clickbaity, and I don't like that. I personally, that doesn't resonate with me. It doesn't make me feel comfortable, and to be quite honest, my trust decreases for individuals who use that as a way to bring people in. And now I'm not saying anything against the guy's the quality of his messages. I haven't done enough research in what the gentleman offers to make a statement on that. But just in the overall, the zeitgeist that I get from trying to get information, right, and trying to understand what to do next, what should I invest in next. If I'm trying to get my information from opinions from people on the internet, I could understand how that's not going to be rational. My decision to invest on the basis of someone's opinion on the internet will not be a rational move. And that's what this research is saying. And I think you see the merit in what I'm saying, because you're here, you're watching this video, and I mean, I'm sure you didn't click on the video because of the icon, my thumbnail. I don't really put much effort into that by design, because the type of individual that I believe I'm delivering value to doesn't really care about thumbnails and cares more about the substance that's being offered. And I believe this is incredibly substantive, at least in the offering of information, peer-reviewed information. So they go on to say that you can use machine learning tactics and data scraping on Twitter to determine the price tomorrow of a cryptocurrency, or maybe in a week, or maybe even 8 weeks out into time horizon. But beyond short and medium term time horizons, in other words, the long term, year or more, what defines price movements for Bitcoin, Ethereum, and beyond? And then they go on to assert that it is in fact Metcalfe's law. Metcalfe's law has been shown to define price movement for cryptocurrencies. Excuse me. Let me see. So they say here, so here's something. Now, you might be thinking, well, Brendan, what about bubbles, right? How does Metcalfe's law and this research handle bubbles or depressions in the price of cryptocurrency? So they say that unique active addresses represent the number of active Bitcoin and Ethereum users, while Bitcoin and Ethereum market capitalization represent network value, right? The model was accurate, with the value of networks growing proportionally to the square number of users. Researchers also presented a model to identify bubble periods in Bitcoin and Ethereum. If the value of Bitcoin and Ethereum increases disproportionately to the number of the square users, in other words, a deviation from Metcalfe's law, then the network is overvalued and should decrease to its equilibrium price. And this is where we get now the intrinsic value, and we get the margin of safety. So the good old principles from Graham Dodd value investing come right back into play, and we can now establish margins of safety in the sense that if we know that the cryptocurrency in question's price should follow Metcalfe's law, and if we find that there is a cryptocurrency not following the law, in other words, let's say it's overly inflated, then we know at that point, if we are holding the stock, it would be rational to sell, because using a quote directly from the book, the security or the cryptocurrency has just become so dear that you can no longer hold on to it and you have to let it go and trade it for cash. And then the reverse is also true. If you're looking at the cryptocurrency and the cryptocurrency is in fact experiencing a deviation in the upward direction from Metcalfe's curve, well, then you know not to buy it. Not to buy it and wait for a correction, because the correction will come. At which point then it would be your decision to strike or not. And they go on to reinforce this. During the short term, Bitcoin's price deviates from its supposed fundamental value calculated using Metcalfe's law. But over the long term, it follows a cyclical pattern and gravitates back to the value calculated by Metcalfe's law. And that is found on page 105. Just so you guys know, I'm not making it up right here. So Investor sentiment analysis using internet search and online social media is a relatively new research field. They go on to say that, however, online data analysis in multiple studies has confirmed the basic principle in behavioral finance theory that the financial markets in the short term are influenced by emotions and behavioral biases caused by various rumors and information spreading online rather than fundamentals. So they're making a distinction here, guys, and they do this several times in the paper, and the distinction is one where it's very clear. In the short term and in the medium term, the price movements, it's not a martingale, it's not a stochastic process, it's not random. It's driven by emotions and irrational sentiment fueled by rumors on the internet. And this is statistically significant, guys, in several research papers. But in the long term, it should follow Metcalfe's law. At the very least, if I'm being conservative, Bitcoin and Ethereum, right? But there's no reason for us to believe that other cryptocurrencies are not also following this similar law. So that's, I guess, how should we take this? We would have to understand now at this point, since we understand that Metcalfe's law is being followed here. Obviously, market capitalization can't increase forever, right? It's not going to go to infinity. So we also know that, let me just show this to you, we also know that any new technology follows Rogers' diffusion of innovation, right? Or sometimes known as the product diffusion model or the product adoption model, where you have your innovators. Let me just pull this. I like this. This image was cute and funny. So you have your innovators here in the beginning who are helping build the technology and using it, beta testing it, what have you. And then you have your early adopters, right, who pay attention to these guys and are quick to jump on board. And then we have our early majority. Here's a global maxima. Then you have your late majority, and then you have your laggards, right? So in research, and specifically in this research here, this is another one that we're diving into, an alternative model of Metcalfe's law for valuing Bitcoin. I won't go into detail on this one, but they mention mathematically that there should be a global maxima here that's driven in part by the fundamentals. And this will be specific to each cryptocurrency, right? So the behavior will be the same. So this behavior will be driven by Rogers' law, and it'll also be driven by Metcalfe's law. But then the actual maxima itself will be limited. So what does that mean practically? Hey, what's going on, Mauricio? So what does that mean practically? Well, it just means that we have to think about cryptocurrency and specifically the individual cryptocurrencies from a fundamental perspective. So we have to look at the technology that the cryptocurrency is being driven by. So for example, Bitcoin is driven by a proof of work protocol, and it's incredibly electrically expensive. And the protocol demands that as time goes on, the problems that are required to be solved in order for the ledger to be stewarded and mined become harder and harder. So I remember GPUs used to be worth $6,000 for these mining rigs. Now they're worth $12,000 on Amazon, and for example, the Antminer sold by Bitmain is always out of stock. So this is not a sustainable practice from the very obvious reason that people are becoming more and more green, more and more concerned about electrical consumption. So not even from a political perspective, but more so from a perspective of demand, you're seeing that younger generations are conscious of these facts, and they have been shown to choose products that are good for the environment, that take care of the environment. So this is definitely a consideration when you think about how high could Bitcoin truly climb. And I think that when people start to realize that there are alternatives in cryptocurrency as cryptocurrency awareness and understanding and education increases, people will understand and realize that Bitcoin You don't have to choose Bitcoin to transact. You could choose something like Cardano. Cardano is 100% stewarded as far as their ledger goes with a proof of stake protocol, which is not as electrically expensive, right? It doesn't use as much electricity as Bitcoin to mine its ledger. It uses a voting consensus. So when people start to realize that, then I think that you'll see there'll be this depression, this global depression on the maximum amount of users that come online for Bitcoin. And remember, the amount of users that come online and transact on the Bitcoin network determine Bitcoin's market capitalization. So then, well, if that's the case, then where are those people going to go? They're going to flood the second generation and third generation cryptocurrencies with the money, with the money that they're going to participate with in the cryptocurrency space. So, with that being said, I will end it here. I hope you guys have a beautiful rest of your night. This was a quick one, but I did want to get this one out because this was just so fascinating to me, and I hope you feel the same. If you're new to the channel, guys, subscribe so you can continue to gain insight on how to analyze business performance, so that way your investment performance is optimized. Remember, when your investment performance is optimized, so is your wealth production. I'll see you guys in the next one. Take care. Good night, guys.